afternoon, everybody, and welcome to Professional Advisors Working Lunch, brought to you in association with our partner, Baillie Gifford. I'm Katrina Lloyd, and I'm Editor-in-Chief of Professional Advisor, and I'm going to be your host for the next hour. Before we get going with today's session, let me quickly run through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. That's to ensure there's no background noise and the speakers can be heard and seen clearly. I should also inform you that this session is being recorded, and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD. We'll be sending you proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. So now let's get on with the session today. Baillie Gifford's Positive Change Fund invests for the future in every sense. It has two objectives: to deliver attractive investment returns and contribute towards a more sustainable and inclusive world. Over the next hour, I'm joined by Alison Henry. She's Investment Specialist Director with specific responsibility for the Baillie Gifford Positive Change Fund. Against the backdrop of persistent high inflation and climate urgency, we will discuss how channeling capital to companies that are challenging the status quo has the potential to catalyse tremendous positive change. Do feel free to put your questions to Alison using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. Just before I hand over to Alison, I'm going to quickly run through our learning objectives for today. So by the end of this session, delegates will be able to outline the attraction of both long-term growth and impact investing, describe the merits of investing in companies that can address global challenges, and summarise the importance of fundamental analysis in impact investing and reporting. So that's the CPD covered. So let's hear now from Baillie Gifford's Alison Henry. Hello, Alison. Welcome. And I'm going to hand over to you now for your presentation. Thanks for joining us.
Good afternoon. Thank you very much. And thank you, everybody, for giving up your lunch break to listen in today. I'm going to start, if I can get the right slide, by traveling through time and extending our time horizons. So the investment community is becoming increasingly short-term, whereas at Baillie Gifford, we don't think with a weekly, a quarterly, or even an annual mindset, but instead we think about the next 5 years and beyond. So let's step beyond that time frame, beyond our time frame of 5 years and beyond the time frame of decades, and instead let's use the time frame of 250 years. So this graph here takes us back to the late 1700s and the onset of the Industrial Revolution, and it depicts 5 technological surges, or trends if you like, over the last 250 years. So first, the Industrial Revolution. So it started before 1800 and it led to mechanization, huge productivity gains and growth in average incomes. Next, we have the arrival of steam and railways, and this improved transportation of raw materials, finished goods. It also created economic opportunity and helped ideas to spread more easily. Third, we have the introduction of steel, electricity, and heavy engineering, and this very much enabled widespread adoption of technological systems such as rail networks, water supplies, and sewage systems, and this was very much thought of as the second industrial revolution. And it allowed unprecedented movement of people and ideas, so a wave of globalization. The fourth surge here, from 1900 onwards, represents the introduction of oil and mass production and enabled greater access to a range of products made from petrochemicals. And then finally, the fifth surge shown here is the information and technology age, the age of greater access to information, exponential connectivity, and digitalization. So what is the point of this? Why am I showing you this? Well, 3 reasons really. First is as a note of positivity. It's to illustrate the phenomenal progress that we have made over the last few centuries. So in many ways, the world is a better place than it was generations ago, in that millions of people have been lifted out of poverty, Life expectancy has doubled in a few generations, and literacy levels have improved from 10% when we started in the 1800s to nearly 90% today. The second point is that we can learn a lot from history. So at Baillie Gifford, we have enjoyed working with some academics at the University of Sussex here in the UK, but also at Utrecht University in the Netherlands, who have applied this historical lens essentially to help us think about the future. And thinking about the future and big societal shifts is critical for long-term investors. And third, and finally, the point is to illustrate that we believe we are at an important juncture in time. If the previous 250 years that started with the Industrial Revolution as the first deep transition, there are scholars that believe we are now in the early start of the second deep transition. So this essentially is a response to the problems created by the first transition. And while there's been immense improvement in the standard of living, as I just mentioned, for millions of people around the world, our world is very much in crisis. So it won't have gone unnoticed that our world is on fire. Climate change is taking its toll, and at a terrifying pace. We saw wildfires ravaging parts of Europe and North America last summer. We saw extreme flooding in Pakistan, yet droughts in India. And this extreme weather is impacting homes, livelihoods, food supply chains. And it's not just climate change that we have to worry about. We might all be living longer now, but not always living healthier lives. And of course, we've just lived through a global pandemic. And although hundreds of millions of people have been lifted out of poverty, there are still around 4 billion people, which is more than half the global population, living on less than $3,000 a year. So that's essentially people living really at the very, very bottom of the income ladder. So it could be said that we are at a watershed moment in time. So we're faced with the choice of continuing on the path we are on, or we have an opportunity if we have the bravery, the ambition, and essentially the optimism needed to help steer the world onto a more sustainable trajectory. And so what if, at this watershed moment in time, we choose to leave behind the wildfires and work towards a more sustainable and inclusive and healthier world? So we have just traveled back in time. Now let's travel to the future. Come 2020, making sure my slide has changed. Come 2020, could London look like this with fewer cars on the road due to more shared electrified mobility, both on the ground but in the air, in the form of these flying taxis made by Joby Aviation, which is one of our portfolio holdings? Could we also see more greenery enabling increased biodiversity? Perhaps we might even see vertical farms becoming a reality in cities like London. Harder to show, but let's assume the standard of housing is more equal underneath these flying taxis, and that within the buildings, more people have access to high quality and affordable education. Training is delivered online, maybe as we're doing right now, or through virtual reality headsets. So to help steer us onto a more positive trajectory, human ingenuity and tremendous amounts of capital will be needed. And this is where we, so asset owners, savers, those directing capital, so investment managers, can play a role in channeling capitals towards companies whose products and services are providing solutions to global challenges. And it isn't just about making or driving change. It's about making good investment returns in the process, because these companies are likely to thrive in the long term. They're going to see rising demand for their products and services, for their flying taxis or electric cars. And these companies will be able to carve out strong competitive advantages, such as establishing loyal customers or attracting and retaining high quality employees that will be motivated by the sense of purpose. So that is why the Positive Change Fund has not one, but two objectives. We seek to deliver attractive investment returns and to deliver a positive social or environmental change by addressing global challenges. So it's a concentrated global equity fund, It invests in exceptional companies rather than avoiding the worst ones, so not negatively screened, very much taking a positive and proactive approach to inclusion. I've talked a bit about the challenges that the world faces, very conscious that they are numerous and some of them might be quite subjective. So to frame our thinking, we adopt 4 impact themes, and this is very much just to bring consistency to how we think about these issues, but also to illustrate it clearly for clients and help us assess the impact of the companies in the fund. So as you can see there, we've got social inclusion, which is looking for companies that are promoting quality, such as access to education. Environment and resource needs, very self-explanatory in that it's looking for companies that can reduce the environmental impact of human activities or companies that can make us more resource efficient. Healthcare and quality of life is looking for companies that are addressing rare diseases, infectious diseases, lifestyle diseases, or just helping us to manage conditions more effectively. And then lastly, base of pyramid is looking for companies that are addressing those 3 billion or 4 billion people, I mentioned, that are living in poverty on less than $3,000 per annum. So we think that by addressing these 4 broad themes, it will allow us to achieve positive change and good investment returns for our clients. But maybe what does this mean in reality? I'm going to talk you through a couple of examples of portfolio holdings just to bring it to life. So 2 companies here, Duolingo and Deer, quite different companies intentionally. So starting with the dual owl that we see on the left. This friendly green owl is the mascot for what we describe as a mission-obsessed company that wants to deliver free and equal access to education. So Duolingo is the most popular language learning app, one that I'm sure a number of you might already be familiar with. You might be familiar with that owl trying to encourage you to do your daily lesson if you've forgotten. And it very much has, Duolingo very much has ambitions to expand beyond language learning and into maths, literacy, and even music. So currently, though, language learning, by providing it for free and providing it in an effective way that is fun, Duolingo has helped to lower the barriers to greater economic opportunities. So I think it's all relative for us learning a second language, perhaps, which might be useful for holidays. It might be very different if you're learning English for business purposes, and that's providing much better social and economic outcomes. It's also helping to improve educational outcomes for children. And there are actually even studies that point to some health benefits of adult learning, so it can prevent the onset of Alzheimer's, for example. But maybe I might hear you thinking, how does a mission-focused company offering free education make a good investment, Baillie Gifford? Well, it's very much monetizing its app through a subscription offering. So it currently has 88 million users, and 8% of them are paying for the app, paying for the premium service. It also sells advertising, and it also generates revenues through online language testing. So if you needed to have a certificate that says you've got a good enough level of English to get this job, that's what they're able to provide. The runway for growth for Duolingo, we think, is very stark. So there's currently 1.8 billion language learners globally. And I mentioned that Duolingo has just 88 million users currently. But what's actually more exciting is that due to its engaging and convenient content, it could actually expand the market beyond the current 1.8 billion learners. So for example, I had no intention of learning Japanese until I found out about Duolingo when we took an investment in it for a positive change. So Duolingo, just to finish up, great growth runway, quite a unique position in the market. So it's got its freemium model, it's got a very strong brand, and it's established that in fairly short order. And that means that it's attracting customers at a very low cost. Most of the customers come through word of mouth. Perhaps I might be helping with that today. And what really excites us about the competitive advantage for Duolingo is that it's getting stronger all the time. The more learners on the platform, the more data Duolingo collects, the better the platform becomes. And then, of course, the better the platform, the more people it attracts. So it's essentially a flywheel effect. And it's a great example of how a sense of mission as well as a profitable business model can go hand in hand, which is actually a rarity in the education sector. So it sits in our social inclusion and education theme. And then looking at one other company, one other of the fund's holdings, Deer. So we've got two of the positive change team pictured here who visited Deer at the end of last year. So Deer is the world's largest agriculture equipment manufacturer. So the two members of the team, Lee and Punit, received a tour of the company's research and development division in Illinois in the US, which gave them first-hand insight into the company's focus on innovation. And by innovation, what I'm really talking about is their leading position that they have in precision agriculture. And precision agriculture is essentially a sustainable form of agriculture that uses sensors, data, automation, and AI, artificial intelligence, to improve crop yields and reduce the use of fertilizer and pesticides. So many of Deer's competitors, they outsource the research and design element needed for precision agriculture to third parties, but Deer is different. It does it in-house. It's made a huge investment in doing it in-house. And its vertical integration essentially enables the company to provide the best equipment to farmers. So I suppose it's similar to how Apple provides a great user experience by designing its chips, but by also doing the hardware and the software in-house. So as well as precision spraying equipment, so identifying what's a weed or what's a crop, the company has also developed autonomous tractors, so driverless tractors, which can work day and night without an operator. And so clearly something like this would free up farmers' time to focus on other tasks, to enable things to be done more quickly, and it helps to address the challenge of labour shortages. Deer is also providing farmers with real-time data and insights on the performance of their equipment and crops, so they can make better decisions. So that might include what to plant and when. And looking ahead, Deer is working on tackling the challenge of emissions from large farming equipment. So it's aiming to electrify its equipment where it can and explore alternative fuels such as hydrogen. And in some cases, this could replace the need for diesel-powered machinery. So that was two portfolio examples. I was going to walk you through a third, but very much from the viewpoint of our impact analysis framework. I'm conscious that many of you will be familiar with numerous frameworks that active investment managers use from the financial side of things, but maybe, or some of you may be less familiar with how managers are looking about how managers are assessing impact, or indeed might just be interested in how we're doing it. So on the slide here, we're showing our qualitative impact framework, and we use this to assess the future impact of any company. So any company that might make it into the portfolio is assessed using this framework. We think about three pillars when we are thinking about future impact. So that's product impact, intent, and business practices. And I'll use Remitly as an example of how we use it. So Remitly is a mobile-based remittance service for migrants, so to transfer money cross-border at a low cost. We've owned Remitly in the portfolio for 2 years now, 2.5 years. Starting perhaps with intent. With the intent part of the framework, we're looking at the management's ambitions to address a societal or environmental challenge, and we look at the actions and structures in place to support this. So for Remitly, the CEO, Matt Oppenheimer, he's very clear and passionate about the company's mission to enable low-cost and reliable mobile remittance services. So the CEO is actually an American, but he worked for, and it's an American company, but he worked for Barclays in Nairobi many years ago, and it was actually the inspiration for establishing the company, having witnessed colleagues and acquaintances having to go to do remittances with an agent in person, people having to take cash along or arrange a money order. And all of this was extremely inconvenient and at a high price. So it very much gave him the inspiration to do it mobile-based and obviously providing a much better service at a lower cost. With business practices on the bottom right there, this is a much more traditional ESG analysis which looks at issues that we believe might increase or decrease the risk of a company achieving its positive impact, but also actually achieving its financial performance. So there's a variety of issues that we would look at here, depending on the company. Broadly, for most companies, we would look at how companies treat their stakeholders, their employees, their customers, their shareholders. We would look at the governance factors, the independence of the board. For companies like Remitly, we would look at data security. All companies were looking at their environmental footprint. So looking at Remitly specifically, they have 2025 net zero aspirations. We look at compensation of the executive management team. It is actually pretty low for a US company by US company standards. It has a 90% customer retention rate, which is incredibly high. We are conscious there is no perfect company in the portfolio, sadly, or indeed we don't think a perfect company exists, and that's with regard to anything, but includes business practices. So the direction of travel will always be important, and this is where engagement with the company will be key for us. So with Remitly, as an example, we would be keen to hear a bit more about how it manages its agent network, how it thinks about its data, and also how it might stay on top of its anti-money laundering obligations. And then we have identified areas where we would like to see improvements. So, for example, we would like to see a more diverse and relevant board of directors over time. As the company just IPO'd in September 21, so it's likely that some of the board members will leave, they came from the venture capital companies originally. And as they sell, we might see a bit of change on the board. And then lastly, product impact. And this is the most important. With the best intent and even with the best ESG practices, if a company doesn't have sufficient product impact, it won't make it into this fund. This is an impact strategy. So here we're asking what a company does and what this means for society and how many people will benefit from it. So remittances are vital in supporting and improving the social conditions of millions of people. So particularly those living at the bottom of the pyramid that I talked about earlier, those living in poverty essentially. And Remitly aims to service the most socially important corridors, which is important from our impact assessment. We do very much think it can drive positive change. But when we think about the breadth of the impact that it can potentially have, this will very much be determined by its market share. But overall, because of its contribution to financial inclusion and therefore better social outcomes, we are very much enthused by the positive impact of Remitly. Once an investment has been made, another important role for us as impact investors is to consistently monitor and report on the impact of portfolio companies. So we do this every year in our annual impact report, and we do it on a company by company level, mapping companies' progresses. So here's Dexcom, which has been owned by Positive Change since inception. So that was January 2017. Dexcom is a company in the diabetes space. So it designs, makes, and sells continuous glucose monitoring devices, which are a replacement for finger stick tests. So their devices are much more convenient than doing multiple finger stick tests a day. But importantly, they're enabling continual readings and enabling trends in glucose levels rather than just a single reading at a single point in time. So the use of these monitors very much helps patients to keep their glucose levels in range. It enables better management of the condition and also better enables prevention of more serious health conditions that would be associated with diabetes. So very much a good example of how our two objectives, impact and investment, go hand in hand. So over the period that we've invested in it, so I mentioned that was January 17, so 7 years ago, the company has expanded its outreach from just under 300,000 patients to over 1.7 million, as shown here. And actually not shown here, but on the investment side, sales have grown from 700 million a year back in January 2017 to now more than $3 billion US. So it's very much moved from being a loss-making company to a profitable company, and the share price over that time period has increased 5-fold. So impact investors aim to invest in companies which are solving an environmental or social challenge. And the Sustainable Development Goals provide us with a very helpful and independent framework for understanding what these global challenges are. We map every company to the SDGs, the Sustainable Development Goals, and we map them at target level. So there's actually 169 targets underlying these goals. And we are pleased to share that at the fund level in aggregate, we map all of the companies to 15 out of the 17 SDGs. We also aggregate the figures at a portfolio level to demonstrate the impact that the portfolio companies are having on these global challenges. And the circle on the right there demonstrates or shows some examples essentially from companies in the portfolio. So on the pink bit on sort of the middle bottom right there, if you're following, there are two companies in the portfolio, one of which is Dexcom, which you can see are providing almost 2 million patients with the ability to manage their conditions more effectively. That was very much the impact side. I've talked a lot about the impact side of positive change because it's equally important, but so is investment. We have, the Positive Change Fund has a 5-year investment horizon, and over that time period, we have outperformed by 4% per annum versus the index. And the since inception returns are even stronger over that 7-year time period. But I'm very conscious that some of you may be invested, you may be much more recent investors and not enjoyed this outperformance, as we have underperformed over the last 3 years. And also over the last year by over 6%. So I thought I would just address that briefly. Thinking about the last year, 2023, it was a challenging year for growth investors, and performance was very much impacted by probably 3 notable areas. So first was the macroeconomic environment. It changed very rapidly. It saw long duration growth companies fall out of favor of the market, and we were very much caught up in that essentially. Second notable factor is what we didn't own. So a feature of the last few years, which has impacted our performance, is the increasing concentration of the benchmark in quite a small subset of companies. So this is the so-called Magnificent Seven companies. They've become a much larger portion of the index and driven quite an outsized proportion of returns. So actually at one point, more than 70% of the returns of the benchmark were driven by these 7 stocks. The Positive Change just has exposure to one of those, which is Tesla. The majority of the Magnificent Seven have been unable to meet our impact hurdle. So there is a rationale why we only have exposure to one. And then the third reason for the 2023 underperformance was, of course, what we did own. So the fund's exposure to biotech and healthcare names is higher than that of the index. And these companies experienced a challenging period of performance in the last year. There's been a much tougher funding backdrop. They've also been impacted by the emergence of obesity drugs, the GLP-1s, and that's led to some share price weakness at companies that are providing products for weight-related conditions. So actually Dexcom was one of these. It sold off because people thought, well, actually, if we're solving obesity, then there'll be less type 2 diabetes theoretically, and actually we won't need a company like Dexcom. And I think it's a little simplistic. Dexcom actually can work very much in hand in hand with a company like this, so you can be managing both in conjunction. And also, if there's questions on that later, very happy to delve into GLP-1s further, which we don't currently have exposure to in the portfolio. And then in terms of what we did own, maybe just the final point there, we also saw operational factors at a few companies. So for example, Ørsted, the offshore wind provider, we actually sold that company at the end of 2023 after poor execution at the company with impairments and a few other issues which we thought demonstrated management maybe didn't have as much of a handle on things as we had thought. So over the long term, and as the macroeconomic environment stabilizes, we are very much expecting to see a broader range of companies driving returns again. And we expect that innovative companies that are making strong operational progress and providing solutions to global challenges will come to be recognized by the market again. Perhaps outlook might also be of interest, and why we are optimistic looking ahead. So we believe here, the portfolio I'm showing you is 30 of the best growth companies that can address global challenges over the next 5 years and beyond and generate attractive returns, financial returns. So the new macroeconomic environment is a period in which we believe we can expect strong companies to get stronger. The increased cost of capital is very much allowing rational competition to take hold, which is a good thing for good companies. So if we look at the portfolio holdings, they are predominantly cash generating businesses. They have low levels of debt, which means they can fund their own growth. And in a period with increased or with higher interest rates, poor quality companies that don't have access to cheap capital anymore, they will find it much more difficult to acquire customers or to fund their growth. And actually, we've already seen this play out in Latin America, where Mercado Libre, it's there in our social inclusion theme on the left. It has consolidated its position as the leading e-commerce platform in Latin America. One of the new entrants, Shopee, was forced to curtail its spending on incentives in this new macro environment. And it's actually closed its operations in the majority of markets in the region. And we've also been making a few new purchases funded by sales over the last 6 months as we continually look to upgrade the growth and impact in the portfolio. And we've also added a few companies that have sold off unduly. As you would expect, though, with an investment horizon of 5 years, turnover is low. It's still less than 20% per annum. Concluding messages. I hope the last 20 minutes or so have highlighted that we are at a watershed moment in time, that capital can be a powerful mechanism for change, and that channeling capital to companies that are challenging the status quo can be good for people, the planet, and savers. It can help us invest and save into and for a more inclusive, healthier, and more sustainable world for us today, but also for our children and for our grandchildren to retire into. I thought I would leave you with some of the exciting areas we're researching on this page here, just to sort of finish with a message of optimism. We are very excited to continue our search for companies that are driving positive change for the next decade. So whether that's companies such as the mining equipment manufacturers, which will be essential for the electrification of the mining industry, as an industry that will play a vital role in the energy transition. We are also excited to explore how AI could be used by companies across the portfolio, or how platform businesses are creating opportunities for inclusive economic growth in developing countries. And so while none of these areas alone will be the solution, collectively they can make a difference. And I think it's very much the same with our efforts. It's going to take many parties in society to succeed, but in collaboration, we together can be part of the solution, which we find incredibly exciting. Thank you for listening.
Thank you so much for that, Alison. Thanks so much for taking us through what you've been doing on the fund and some of your key thoughts there. Really interesting. We've got a couple of questions, but would encourage you as well to put any questions for Alison up, and we'll ask them. Wanted to come back. We've got a question here about the Magnificent Seven, and I wanted to ask you something about that as well. So the question is, why do you believe that in the medium term the index will become less dominated by the Magnificent Seven? And I suppose another question there is, you mentioned those impact hurdles for those 7 stocks there. You've got one of those, but maybe you could just explain a bit more about what those impact hurdles are.
Yeah, absolutely. So maybe the first question I'll address, which is probably is a tricky one to answer, and also I should hasten to add that we're very much not predictors of what the index will be doing. So I've maybe sort of caught myself in a circle there, that by saying that we think it'll be driven by more sort of rational, broader number of companies. I think it's more just in terms of rational behavior. I think we've seen a very challenging period where a lot has happened very quickly in terms of interest rates rising, in terms of the macroeconomic shift. And I think everybody has now sort of taken a year or two and got a bit more used to that. They're a bit more comfortable with the fact that rates are unlikely to continue to rise from here. We're seeing a lot of central banks around the world, predominantly being the US and the UK, which is driving it, and being a lot more stable in terms of thinking about increases or reducing that going forward. So I just think with that macroeconomic environment now a bit more settled, I think that's why we believe that there'll just be a greater number of companies that will be driving returns. It'll be a lot more rational, there'll be more competition, less volatile in terms of the swings that you're seeing out of one sort of like growth stocks into, you know, more of a value play or vice versa. And sorry, the second part to your question, the Magnificent Seven, why do we only own one of them? It's a good question. We actually have owned Alphabet historically in the past, which is another of the Magnificent Seven, and we very much own it, its ability to provide information to millions of people around the globe. So people that maybe didn't otherwise have access to that information, you know, if they could get their hands on a smartphone or get into a library or an internet cafe, suddenly, you know, they had all of this information, which is incredibly powerful. And that was very much the impact side of the company. Investment, it was a great return over the time period we owned it. We probably owned it for about 5 years. We eventually sold out because we felt that that impact case had largely played out. Alphabet also had a number of other projects. So it had its Verily Life Sciences business. It also had the hot air balloons, I forget what they call it now, that were providing internet access to parts of the world that didn't have it. And all of those hadn't really grown as we'd expected. It was really just the core part of the business. And so a combination of impact factors led us to essentially sell out. And then in terms of the other companies, I won't go through each one, but if we think of maybe Meta, it's a social platform, which I think is great. But in terms of having a real sort of impact, and when we talk about sort of impact hurdles, we can almost distill it to something as simple as, is the world a better place for having this company? And is this company really addressing a challenge, whether that's a social or environmental challenge? So I think it's what Facebook's doing is great, but is it actually addressing a real global challenge? I'm not sure currently if it is. So for us, it didn't really meet the impact hurdle to get into the portfolio. And yeah, I won't go into all seven because you might also be testing me to reel off all seven at once. But if there's any specific questions on any of those, feel free just to pop them in the chat and we can circle back.
Yeah, and I suppose those theses can change over time as we've seen some of those big companies making decisions about how they're going to move strategically going forward, and that's sort of changing as well, isn't it?
Absolutely. Yeah, never say never. Companies evolve, and that's actually what we like to see with companies. And if they evolve, absolutely, we might invest in them in future or reinvest potentially. Yeah.
And what are you seeing? You mentioned about AI as part of the presentation, and what are you seeing with some of your holdings there in terms of how they're adopting AI, how they're looking at it in terms of the future and what it means for businesses? Some really, really exciting sort of developments happening there.
Yeah, AI is incredible in that I think we've been talking about it for a decade or plus, but then it sort of feels like suddenly in the last year, it's really, we've actually seen it sort of tangibly take off in terms of here at BG and Baillie Gifford, we're using ChatGPT in our daily lives now at work, which is not something that we were doing even just a year ago. Companies in the portfolio are using it to increasing extents. So I would say maybe Tesla is the most obvious example that's been using it for a long time. It's all 7 years that we've owned it in terms of collecting, in terms of the autonomous driving part of things and collecting all that data. It's AI that's essentially capturing that data and learning and teaching the cars to continue to drive themselves. So that's a very obvious example, but then we're seeing it for the companies I mentioned today. So Deere with its autonomous vehicles, but also with identifying what's a crop and what's a weed. Duolingo and also another education company, Coursera, they're very much using AI to keep you sort of engaged in the platform, which actually is why they're so successful, because I think if we both got the same language lesson, you might be a bit better than me and then you would get bored quite quickly. But Duolingo is so good at adapting it to the individual user based on what you got right and what you got wrong, and that keeps you engaged. It's not too difficult, but it's also not too easy. And then maybe lastly, just the healthcare names. I think AI has been quite critical for the likes of Moderna. That's how it was able to produce the COVID-19 vaccine so quickly. And it's now leveraging on that with its pipeline. So hopefully we're seeing the RSV and flu vaccines going to be released later this year. But similarly, Illumina, the gene sequencing machine company, is also using AI. So I do think it's there's a lot of exposure across the portfolio, and I think that's only going to increase over time.
I wanted to ask you about your engagement and what effective engagement looks like for you, how you sort of keep track of that, and maybe you can give us an example of where you've used your influence and had that engagement with a company that has paid off and had results for you.
Yeah, that's a good question. Engagement is critical for us as long-term investors, supportive engagement. So we're very much engaging with companies based on three factors, if you like. So we're getting to understand businesses much better. We're looking to build relationships with the management teams. And then thirdly, we are very much looking to support them and potentially affect change where we think that is needed. So that will vary massively from company to company, whether it's affecting change on the board, whether it's asking a company to disclose more data where we think it's lacking a bit. In terms of a good example, I'm trying to think maybe of a more current one. Illumina maybe has been a good one because we've owned Illumina for 7 years in the portfolio, and it's had a much more challenging time lately. So it acquired or spun out Grail, a blood diagnostics company, and then it bought it back. But it tried to reintegrate it into the business before it actually got regulatory approval, which it has now not received. So we did a lot of engagement with the management then. We then became aware that they were going to change their CEO and also change their board. That's been quite critical for us now. So it's almost sort of like going back again to do that understanding and relationship building piece again, understanding the motivations of the new CEO who we've met, and trying to build that rapport and then support the CEO, but also the board. And we've met all new members of the board now as well. So I think it's always ongoing. I think people sometimes think about engagement in terms of, okay, what did you set out to achieve and did you do that? And as if it's sort of a checkbox over 6 months. But, you know, if you're owning companies for 7 years, some of that might be achieved over, you know, that time period, but some of it is also sort of ongoing. And for companies in the portfolio, I mean, a lot of it will be sort of multi-year type engagements that we're trying to do. And that's, I think, a great thing. And we want to grow with companies or help those companies grow for our clients so that they ultimately are good returns and having a positive impact.
Yes. I've got a question here. How do you feel about the weight loss drug companies?
Yeah, it's a really interesting area, and actually, potentially, if we think about it from an impact perspective, they could potentially be the most impactful thing in the healthcare space that we've seen in, you know, I was going to say a decade, but then maybe the COVID-19 vaccine is more impactful. So I think it's a really interesting area. We actually had one of our impact analysts, Apricot, out at the Novo Nordisk Investor Day last week because they have a successful obesity drug. So it's not an area we currently have exposure to in the portfolio, but we're looking at. We don't currently have exposure because although clearly what they're doing is great, it's not a silver bullet. So compliance is currently quite poor for them. Currently, they're delivered via an injection, and I think in time we're going to see that via a tablet and oral form, which will improve compliance. But there's also quite a few nasty side effects. So we're thinking quite a lot about that in that, you know, is it worth it essentially if you're having these nasty side effects? And then lastly, not everybody will necessarily have that, but it's something to consider. And lastly, if you stop taking them, they immediately stop working. And I think what we've seen so far is that people might take them for a year, or certainly their insurance might cover them for a certain period of time if they're US basis where it's been largely trialed or used so far. And then when they stop taking them, then the weight goes back on, and it's just the challenges of that and the health impacts of that if you're sort of having, you know, big shifts in weight. So I think definitely a very interesting area, definitely something that we're looking at. Currently no portfolio exposure.
Great, thank you. I wanted to ask you as well about getting the right information and data that you need from companies, I suppose, especially some in the sort of more of emerging market countries where it can be more difficult sometimes to get all the data that you need. How have you found that, and how are you seeing it evolving in terms of companies' own reporting on some of these areas?
Yeah, I think that's a really pertinent question or a really valid question. It is hugely varied, and you're right, it's hugely varied, mainly based on geography, but not always. Because what we also see is that we invest in quite early stage companies, and if they've only IPO'd last year, they're not used to having to engage with external shareholders. They're not used to sort of having these demands, and they certainly don't have that disclosure piece right from day one. Then you might ask a new company, or indeed a company in an emerging market, what are your net zero aspirations? You know, they will have very different answers to, say, an established US company. So I think it's all about context, and I think that's actually one of the benefits that we have. We have a 30 stock portfolio. We can, you know, have those in-depth conversations, but also we can have that context. You know, we're not trying to do a really difficult job like, you know, Morningstar or MSCI, where they've got thousands of stocks and they're sort of forced to try and put like an ESG rating on them. And how do you have that context? And how do you, you know, it's really difficult what they're trying to do. So yeah, it's very much speaking to each company. Direction of travel is important. So if on day one, you know, there's not that disclosure, you set expectations, and then, you know, you expect to see that improve over time. And then if it doesn't improve over time, you know, that's maybe when you have to take action. So we actually sold M3, a Japanese healthcare platform company, at the end of last year. And a part of that was that it has been quite difficult to get information from the management team to get that disclosure that we would like to see. And it's not been improving over time. And this is not atypical with Japanese companies, but the direction of travel has been a bit challenging. And the business was becoming more complex, but without that transparency, we felt it was increasing risk. And so ultimately, after I think it was 6 years we've done it for, we decided to sell out, partly based on that.
Obviously, greenwashing, the term's been around for a while and can mean different things to different people, but it is still an issue. It's an issue for advisors as well. But how do you combat greenwashing? What are key tests for you that a company's doing what it says it's doing?
A very tricky topic, because everybody's now got some ESG slant or whatever. So I think it's that disclosure piece that you mentioned already there. If a company is disclosing what it's doing and it can actually back it up, then clearly that's hugely helpful. So a company's got net zero aspirations, if we're thinking about it from the environmental side, you know, and then they can actually demonstrate their emissions, and they're tracking scope 1, scope 2, and scope 3 emissions. You know, all of that is really actually showing that they are thinking about this more deeply. So it very much depends on the topic, I suppose. You know, governance is a big piece, and that's probably a little bit more subjective. But again, it's helpful that we have access to these management teams. You know, we are very lucky at Baillie Gifford that because we're known as long-term investors, we do get that access. Companies do want to speak to us. So I think when you're sitting in meeting rooms, you're having these conversations, you know, you are getting that access, and you can tell if somebody's, you know, knows what they're talking about, or whether this is just sort of something that they're saying because it sounds good from an ESG perspective. So I think that's on the company side. But equally, we have a responsibility ourselves to demonstrate that we are meeting our impact objectives, and that we're monitoring, we're measuring, and reporting on impact properly. So we do an annual impact report, and we also produce an annual ESG document with the carbon footprint for the portfolio, and looking at the ESG factors. So both are available if anybody's interested on our website.
And what about decision making over this year in the run up? We've got the US election happening in November. A lot of discussion around the political climate. How is that impacting the team, and could it potentially impact some of the holdings you've got there in the fund?
Yes, we do have, we're underweight the US, but we do have good exposure to the US. In terms of how we think about, maybe take a step back, geopolitical risk sort of more generally, something that clearly we think about, but we're not trying to predict macroeconomic environments or scenarios. I mean, we do not know who will be the next president. I think last time we guessed incorrectly when Mr. Trump was successful. And I think everybody thought that would be terrible for stock markets, but actually it was really good for stock markets initially, which again, you know, it sort of shows the trickiness of trying to predict these things. That's not what we're trying to do. It's very much just focusing on it from the bottom up, stock perspective. You know, Tesla, a US company, we've owned it for 7 years. We owned it throughout the last presidency. Do we think that it might be impacted by Trump versus Biden in the White House? Maybe over that sort of initial period, but looking at this company over sort of the 5 years and beyond the time horizon of our US president, that's how we're thinking about it, rather than sort of trying to play macro scenarios, which we'll almost certainly get wrong.
Just got time for a couple more questions, so would encourage you again to put any questions forward as well. I wanted to ask you about the development on the social side of things. You mentioned that in your presentation, some interesting companies there, and that's become a much bigger area of focus for investors as well. Well, what's exciting for you going forward in that area, and what are some of the developments that you would highlight?
Yeah, that's a nice question, actually, because I think the social side has become slightly easier. When we started Positive Change 7 years ago, it was everybody sort of thinking about, the environmental side of things, and that was much more obvious. But the social side, I think, has become a lot more prevalent. We talked earlier about sort of the language learning Duolingo, but actually one that we've just bought in the portfolio is Grab, which is a Southeast Asian ride-hailing and food delivery company. And it's quite interesting because initially, when our impact analysts looked at it, they were very much skeptical that it would actually have sort of an impact case for us. They were like, well, our ride-hailing, sort of Uber-type drivers, but Grab is the company which is trying to make it comparable for us because we're familiar here with Uber in the UK. Are they not very much gig employees? They don't necessarily have benefits, and it's not maybe a long-term sort of career trajectory for people. But actually, we then commissioned a company called 60 Decibels, which is a social impact organization, to do some research on Grab for us. And they actually interviewed 600 people in Indonesia and it was in the Philippines, two of the areas in which Grab operates, on the impact of Grab in people's lives. And it was drivers, but also it was people, small businesses that were getting their food delivered much, much more widely as a consequence of Grab's platform. And actually the outcome was that the social impact and the economic opportunities for these people was huge. And actually they all resoundingly said, Grab is making our lives a much better place. And so then the impact analysts had the confidence to therefore kind of actually back the company, get it into the portfolio. It was always very clear for us on the investment side. I think it's actually a really nice example of where we definitely have that conviction that this is a company that is improving the lives of people from a job perspective using it. And then I'm sure people who are using it is much more convenient as well, which is really great. So I think definitely better social outcomes for Grab. And it will be, that's just one example. I've mentioned language learning. It will be quite far reaching. There'll be a number of different areas and we'll continue to keep finding them.
And just finally, of course, conscious of our time today, but just finally, you mentioned it in the presentation, but looking ahead, what are you sort of most optimistic about for the next 5 years in terms of the strategy and the potential there?
Great question. I think it's difficult to ever have the most optimism about one different area. I think it's just the range of different outcomes that we can see. 5 years ago, if you'd said what is going to be, the company that's going to be the most successful over the next 5 years, I think we would have got it wrong, actually. So it's sort of like the e-commerce platforms in Latin America that have really been driving returns, or it's been the likes of, the language learning apps. It's just been companies that sort of came out of nowhere and hadn't even IPO'd 5 years ago. So I think it's just the range of different outcomes and the fact that we are really seeing companies that can really move the dial, that they are addressing issues, because I think we're not going to solve climate change over the next 5 years. So I think you can't pinpoint any sort of one company in that area, but it's more just the sort of the huge wealth of different opportunities that are out there. And I think that last page that we landed on very much sort of summarizes them. It could be driverless taxis in the sky, or it could be another app which is really moving the dial in terms of making the world much more equal. So the range of outcomes, I think, is what's exciting.
Great. Well, thank you so much for joining us today, Alison. It was a really fascinating presentation, and thanks for your insights as well in the Q&A. Before we wrap up today, just a quick look at those learning objectives again. So by the end of the session, delegates will be able to outline the attraction of both long-term growth and impact investing, describe the merits of investing in companies that can address global challenges, and summarise the importance of fundamental analysis in impact investing and reporting. Thanks again to Alison, as I said, for joining me and for taking the questions. If you do have any other questions, I'm sure Alison and Baillie Gifford will do their best to answer these after the event. And as I said earlier, your CPD will also be delivered tomorrow. Just before we close, I wanted to leave you with a teaser of what's to come from professional advisor events over the next few weeks. We're all rushing here tonight to the brewery in London, tonight's big Professional Advisor Awards, where we'll recognise the great and good in the industry at what's now established as the biggest awards event for advisors in the business. So I'm sure we'll see plenty of you there, and we wish our finalists the best of luck. If you're watching this session, you're anywhere near Wilmslow, Macclesfield, Ely or Bristol, you should expect an invitation to one of 3 regional working lunches with Goldman Sachs Asset Management and L&G. These lunches offer you a fabulous meal while listening to 2 presentations in a fabulous setting near you. You'll hear from GSAM, who will be addressing the key issue of how active managers are taking advantage of AI and big data to make even more informed decisions. And in these days of continued uncertainty, L&G will offer their views on maintaining a sustainable retirement income. We're then at the magnificent Mottram Hall between Wilmslow and Macclesfield on the 16th of April. On the 17th, we're in Cambridgeshire at the Old Hall in Ely, and we'll round off our series on the 18th of April at the Bristol Golf Club in Almondsbury. So do keep an eye out for information if you live anywhere near those venues. Then on the 25th of April, we'll be hosting the annual PA360 conference at a new London venue this year. As the conference continues to grow, it's now the largest annual conference for advisors in the UK. We've moved the venue to 133 Houndsditch in the city. And this year's conference will bring together over 40 expert speakers covering everything that advisors need to know on investment, technology, regulation, protection, platforms, retirement planning, M&A, and of course, AI. And this event will be rounded off in this election year by our keynote speaker, former Labour Chief Secretary to the Treasury, Ed Balls. It should be a great day, and we're very much looking forward to seeing you there. And finally, on the 15th and 16th of May, we'll be running the second edition of our very successful Professional Advisor Management Retreat at the magnificent Wootton House near Dorking in Surrey. This is a 2-day conference aimed at those who own or are senior directors in advice firms. And over the course of the 2 days, delegates will have the opportunity to attend boardroom sessions from our 8 sponsors, as well as listen to some fascinating presentations from a variety of outside speakers. We'll be announcing details of all speakers in the next couple of weeks, but please make sure to put this date in your calendar. Places are limited, so register now to avoid disappointment. So all in all, that's a total of 17 hours CPD over the next few weeks and a big night out to celebrate the best in the industry. As usual, if you wish to get more information or sign up to any of our events, you can do so by visiting professionaladvisor.com/events. So that's it for today's working lunch. All that remains is for me to thank Alison once more for her presentation and answering our questions. And as ever, our greatest thanks go to you for your company this lunchtime. We hope you found the session helpful and worthwhile. We hope to see you again at another event very soon. Goodbye and enjoy the rest of your day.